Hello, and welcome to your Daily 5. I'm Greg Harmon, founder and president of Dragonfly Capital Management. At Dragonfly Capital, we manage portfolios for clients in separate accounts using Interactive Brokers as a custodian for those, and use technical analysis and option strategies to try and maximize returns with minimal capital invested. We also, for the do-it-yourselfer, put out a newsletter that you can subscribe to that gives you ideas on how to trade your own account and how I look at markets to help you gain a different perspective on how you could look at your own investment portfolio. You can find out more at dragonflycap.com. Today, we're going to try and answer a question that's been going around in the market for the last 6 months, and that's, where are equities headed? There's been a big debate going on in the marketplace since the perception that inflation may be under control and that interest rates may be at their peak or close to it, as to what the impact that'll be on the equity markets. With a big contingent talking about, well, we've just got to the point where we're topped out now, and we'll start selling the actual event, and markets will need to go down and retest the lows or make new lows in one camp, typically the same camp that is calling for a recession to happen, that same recession that we've been calling for every month for the last 6 months. And then there's the other side that says markets are done going down. We've been in an uptrend since October, and we've got even more evidence building day in, day out. So there's some fundamentals that get brought into this as well that I'll talk about as we go along the way. But let's start with a couple of pictures as to what's going on in the background. The first one is gold. And here we've got a weekly chart of gold. We can see that since mid-2020, gold has really just been moving sideways in a channel between 1,700 and 2,050. Promising look last week with gold going up and touching near new highs, but couldn't hold up. And it looks now that even if you were to back out of this chart and look at it on a monthly basis, that it's still going to fail this month if we continue at the same pace that we're going now to make new highs. So failing to break out of this range. But that's going on in an environment where we've got inflationary potential fears, or is inflation under control? The backdrop of the recession that's possibly going to happen, and is this a safe event to purchase gold? Is the dollar collapsing? Is there going to be a problem that we would want to get out of dollar-based assets and into hard assets like gold? And really what we're seeing is that the reaction in the market for gold is it's sitting on the sidelines and saying, you know, I don't see any of this as big problems at this point. So what about the dollar? The dollar had that big run up in 2021 up to the peak at just over 114 in the dollar index in October, September of 2022 before starting to fall back. Starting to fall back in September 2022, has been finding support when it gets back to about that 100 level and bouncing around between 100 and 105-ish. And we're seeing a little bit more of that continue as we go on today. This is not the collapse that market participants are foreboding. This is not the rush out of dollar-based assets and the demise of the US dollar as a reserve currency. This is just a normal pullback, and essentially back to a range that's held for something like 7 years. So this is not a panic in the dollar either. So no panic in the dollar, no panic in gold, nothing that's going to disrupt markets in either of these marketplaces. Next piece of that puzzle I wanted to talk about is the VIX, the Volatility Index. And you can see this on a weekly basis. What I want to focus on is this little chunk here that has happened underneath what was prior support and a range that had held the VIX for all of 2022 while the Fed was tightening. So the perception that we moved up to an environment where inflation was rough and markets were going to start to get more volatile to the downside. And we had this support level around 18 in the VIX. Ever since we moved into the second quarter, we've been below that support level on a weekly basis and for the most part on a daily basis as well. So Volatility Index says that equities are back in this range where there's going to be less volatility. There's less concern about big changes. There are narratives that are going on out there that say that this is because the VIX is broken, and the VIX is broken because of 0 day to mature to expiration options trading. And therefore, the VIX, which looks at 1 month options, is seeing a lot less activity, so it's not calculating correctly. But the VIX is also an item that's trading in the futures market, and the futures market, which should be able to account for that, and is essentially telling us that there's very little volatility in the marketplace. So how do we translate that into equity markets? No panic in gold or inflation, no panic in the dollar, equities, very little volatility. It's like you would expect when you look at the Nasdaq 100. After pulling back and retracing essentially 61.8% of the move from the 2020 low to the 2021 high, it's been moving higher. Been moving higher since October, and just last week broke through its 100-week moving average. Broke above the high from the middle of 2022, the August high. This is confirmation not only on a short-term basis from these higher lows and higher highs, but now on an intermediate-term basis of another higher high. The Nasdaq is chugging along. The Nasdaq is saying, we're out of this now. This is get back to normal time. And finally, looking at the S&P 500, similar type situation, right? It pulled back almost to the penny, 50% of the move from the 2020 low to the 2021 high before starting to move up higher. It hasn't had the same strength that the Nasdaq has had, and it has not yet surpassed its August high, as we can see, but it has had higher highs and higher lows, with last week ending at another higher high right around its 100-week moving average. So does this make sense? Yeah, it kind of does, right? We haven't really even seen much change in the accumulation distribution line for the S&P 500 during this whole pullback of 2022, but it's going back higher now. We saw with the earnings reports last week, we've got about 95% of the S&P 500 companies have reported earnings now, and earnings are coming in much better than they were anticipated to. Lower than had been, but much better than expected and positive, and with expected growth into the future. This is saying that the equity markets now are corroborating the evidence that we're seeing that if there's going to be a recession, the recession is going to be short, and it's going to be done with quickly because markets are already looking past it and starting to move higher. So where are equities headed? I'm in the camp that we're going to see new highs before we see anything near what we saw as the lows from October last year. So are we going to see 4,800 again in the S&P 500? I won't go as far as saying it's going to happen this year, but it certainly looks like that's the direction we're heading now. That's your Daily 5. Thanks for watching.